It's $38.43 trillion. That's the U.S. government's debt as of January 7th, 2026. And before you click away thinking, that's Washington's problem, let me hit you with the part that is your problem. If the government can't realistically pay $38.43 trillion back the normal way, then it has to pay it back the other way, not by missing payments, not by announcing a default, but by making the dollars you're paid in, it's quietly worth less. Tonight, this video is called America's Quiet Default: How Your Savings Pay for $38 trillion Debt. Because this isn't just a macro story, it's a story about your paycheck, your savings, your 401k. And why doing everything right still feels like you're losing. And if you've ever thought, I make good money, so why do I still feel broke? You're exactly who this is for. Welcome back. Comment your city and the time you're watching, because this isn't happening in theory. It's happening in real time in every zip code. Let me introduce you to someone I'll call Chris. Chris is 34, smart, high-performing, the type who did the whole script: degree, promotions, career track. Chris is pulling in six figures in a high-cost city. And still, Chris feels like life is a treadmill with the speed dial snapping off. Because here's Chris's real life. Rent jumped. Insurance jumped. Groceries didn't come back down the way headlines promised. And every time Chris gets a raise, it's like the raise evaporates before it even lands. So Chris does what responsible people do. Emergency fund in cash. 401k contributions. A balanced portfolio, some stocks, some bonds, because that's what you're told is safe. And then one night, Chris sees a headline about the national debt crossing $38 trillion. Chris's first reaction isn't politics, it's math, Chris thinks. Okay, if the debt is that huge and interest alone is massive, how does this end? Because here's the fear Chris can't say out loud. What if the way this ends is that the system doesn't collapse loudly, it just keeps running? While your money quietly buys less every year, that's the quiet default. And the reason Chris can't shake the feeling is because the numbers don't behave like opinions. They behave like gravity. People argue about whether debt matters, but here's what nobody argues with: speed. As of January 7th, 2026, the total U.S. gross national debt sits at $38.43 trillion. And that number didn't crawl there. Over the past year, the debt increased by about $2.25 trillion. That works out to roughly $6.17 billion per day, $257 million per hour, $4.29 million per minute, about $71,000 per second. While you watched those last two sentences, the number moved again. And here's the part that hits different when you re a high-functioning system skeptic. This isn't just government debt. This is the shadow number sitting behind your entire financial life. Because when debt rises that fast, the government doesn't need a villain. It needs a buyer. And when you zoom in, you find something even more revealing: this $38. 43T has two major parts. About $30.81 trillion is debt held by the public. About $7.62 trillion is intergovernmental debt. In plain English, a huge portion is owned by investors, institutions, pensions, funds, and yes, foreign holders too. So the question becomes, who's holding the bag while this number keeps compounding? And now let's talk about the real monster in the room, not the principal: the interest. Here's a line that should make your stomach drop. In fiscal year 2025, the U.S. government's net interest outlays were about $970 billion. Not to build anything, not to fix anything, not to fund a future, just to service the past. And if you think almost $1 trillion still sounds abstract, translate it into a budget reality. Roughly 1 out of every $7 the federal government spent in FY 2025 went to net interest. 1 out of 7. That's not a line item anymore. That's a gravitational field, and it's accelerating. FY 2002 for net interest was about $881 billion. FY 2025 was about $970 billion. Now zoom in to the end of 2025. In the final 3 months of 2025, net interest ran around $276 billion, total about $92 billion per month. That's the kind of monthly bill that changes a country's options. And here's where the trap tightens. The average interest rate on the total marketable national debt was about 3.362% as of December 2025. 5 years earlier, it was around 1.552%. That's not a small increase. That's the difference between a manageable payment and a payment that eats the budget alive. And there's another hidden pressure most people miss. A large chunk of marketable debt matures fast. Roughly a third of publicly held marketable debt has been projected to mature within 12 months in recent data. Meaning this isn't a one-time problem. This is a refinancing treadmill. So imagine you're the government. You need to roll old debt into new debt, but the rates are higher than they used to be. And every rollover increases the interest bill. This is why people use the phrase debt spiral. And once you're in a spiral, you don't solve it with a motivational speech. You solve it with mechanics. So now we ask the question Chris asked. If the government can't realistically cut enough spending, can't realistically raise enough taxes, and doesn't want to default, what's left? This is where the quiet default enters the room. When most people hear default, they imagine missed payments. It's not what we're talking about. A quiet default is when you get paid back, exactly as promised. But what you receive buys less than what you lent. If I borrow $100 from you today and in 10 years I pay you back $100, I didn't default in a legal sense. But if those 10-year later dollars buy half as much life, then in real terms, you didn't get paid back. You got diluted. Now here's what makes this uncomfortable. The US can always create dollars. Okay. So the US is unlikely to run out of dollars. The real question is, what will those dollars be worth when they arrive? And you can see the tension already in official inflation data. The Consumer Price Index for December 2025 showed inflation running around 2.7% year over year. That sounds tame. But then you look at the parts people actually feel. Food is still rising. Insurance costs don't feel 2.7. Housing doesn't feel 2.7. And Chris Sauer, guy in the story, doesn't live in an index. Chris lives in a cart at the grocery store, a rent renewal email, and a monthly payment calendar. So here's the psychological trick that keeps quiet default invisible. Most people experience inflation as a personal failure. I must be budgeting wrong. I need a side hustle. I should move. I should just work harder. They don't see it as a policy environment where currency dilution becomes the least painful escape hatch for an over-leveraged government. But the incentives are real, because when inflation is higher than the effective return you earn on safe savings, your savings become the funding source. Not through a bill Congress votes on, through a silent transfer. And the scariest part, you can be doing everything responsible and still be the one paying. Now let's get surgical. How does the system actually pull this off? 3 mechanisms. And the first one is the core of quiet default. The engine of a quiet default is simple. Keep the government's borrowing cost below the real-world erosion of money. In other words, if your money loses purchasing power at a faster pace than the government pays you interest, then creditors lose in real terms, and the debt burden shrinks in real terms. That's the play. And to understand why this is so tempting, look at the scale. On $38.43 trillion, every 1% increase in interest rates is roughly $384 billion per year. That's not a rate hike. That's a second budget. So when you hear central bankers talk about balancing inflation and growth, there's an unspoken constraint in the room. Higher rates don't just slow the economy, they detonate the interest bill. And this is why official projections start sounding like a forecast of a slow-motion takeover. Net interest is projected to become a larger and larger share of federal outlays going forward, numbers in the teens as a percentage of spending. This is where Chris's world and Washington's world collide. Because Chris's safe choices, cash bonds, conservative allocations, are the exact places that get bled when real returns go negative, quietly, legally, over years. Now, you might ask, okay, but who keeps buying the debt if it's such a bad deal in real terms? Perfect question. That brings us to mechanism number 2, and this one is about forced demand. A pure free market, a borrower drowning in debt pays a premium. But governments don't play the game like households. They write the rules of the game. And in modern finance, there's a powerful reality. Banks, insurers, and large institutions are strongly pushed toward holding assets considered safe and liquid, and U.S. Treasuries sit at the center of that universe. Treasuries are treated as a cornerstone of liquidity, collateral, and regulatory comfort. So even when the real return is unattractive, demand doesn't vanish the way it would for a normal borrower. This creates a type of built-in buyer base, not because every institution loves the yield, but because the system is built so treasuries remain the default gravitational asset. And here's how this shows up in real life. Chris logs into the 401k provider. Chris sees bond funds inside the safe allocation. Chris doesn't consciously choose to finance government deficits. Chris chooses responsible. But responsible in this era can mean low risk in name, guaranteed erosion in purchasing power. Now we get to the third mechanism, the one that turns the whole machine from market-driven into something else. Because when natural demand isn't enough, there's always a buyer with infinite balance sheet, the central bank. Let's be precise, because this is where people either get emotional or get serious. On December 10, 2025, the New York Fed's trading desk stated it would begin reserve management purchases starting with roughly $40 billion in Treasury bills beginning December 12, 2025. They framed it as a technical move to maintain ample reserves, and that may be the intention. But here's the structural truth. When the central bank is buying government debt, even for technical reasons, the system is showing you the direction of travel, because historically these tools don't stay temporary when the underlying problem is permanent. And the underlying problem is permanent if debt keeps rising, interest costs keep compounding, and political reality blocks the two hard exits, austerity or massive tax hikes. Meanwhile, the Federal Reserve's balance sheet still sits in the trillions. So Chris asks a new question now. If this is the world we're in, what does safe even mean? Because Chris can feel the squeeze. Cash feels like decay. Bonds feel like controlled loss. And the only way to preserve purchasing power starts sounding like risk. That's not an accident. That's a feature of an era where saving becomes less rewarded, and asset ownership becomes the only life raft. And this is the moment where the quiet default stops being an academic concept, becomes a personal decision. Because the government doesn't need to announce a default for you to experience one. Experience it every time your savings buys less life. And in the next sections of this video, we're going to pull the curtain back even further. What this means for the middle class, why this accelerates inequality, and how to read the warning signs early before the next stage of the wealth transfer feels sudden. Because the truth is, the debt isn't disappearing. Your purchasing power is. Chris doesn't feel a quiet default in a textbook. Chris feels it when the pay raise hits, and then vanishes into rent, groceries, insurance, and a car repair that somehow costs 30% more than the last time. So Chris does what most responsible people do in January 2026. Chris opens the 401k dashboard. Chris looks at the safe side of the portfolio. Chris realizes something brutal. The part of your money that's supposed to protect you is the part that quietly funds the system. So when new money gets created, it doesn't land evenly. It doesn't float down like snow over every household. It enters through the financial system first. And the first people who touch it, banks, institutions, asset markets, get to spend it before prices fully adjust. By the time it reaches wages, the price tags have already moved. That's why this era feels like two Americas at once. One America watches stock portfolios and home values go up. Another America watches groceries and rent go up, while savings quietly fall behind. And look at the timeline that shaped Chris's adult life. From 2008 onward, the Federal Reserve's balance sheet expanded massively, peaking around $8.9 trillion in 2022. By 2025, it had shrunk, but it was still around $6.5 trillion. That's not a political statement. That's scale. And while all of that was happening, inflation didn't just happen in one bad month. It came in waves. From 2021 to 2025, annual inflation prints ran roughly 4.7% 2021, 8.0% 2022, 4.1% 2023, 2.9% 2024, 2.7% 2025. Chris hears 2.7% and laughs because Chris doesn't buy inflation. Chris buys life, and Chris's life doesn't feel like 2.7. So Chris asks the question most people are afraid to ask out loud. Is the system designed so the responsible middle class becomes the donor class? That question takes us to the blueprint. Because none of this is new. This has a historical template. And the template has a name. Financial repression. Let's rewind. April 1942. The Federal Reserve commits to a wartime interest rate peg capping short-term Treasury bills near 0.375%, and implicitly holding long-term Treasury bond yields around 2.5%. That cap lasted through the war and the tension ran into the early 1950s. Now look at what happens right after World War II. Inflation doesn't politely wait for savers to catch up. In the immediate post-war years, inflation surged. In 1946, inflation ran about 8.5%. In 1947, about 14.4%. In 1948, about 7.7%. Now do that math with a long bond yield capped around 2.5%. You weren't earning a return. You were surrendering purchasing power year after year, legally, quietly, and it worked. Because the government didn't have to pay down the debt the way you pay down a mortgage. It liquidated the debt by paying it back in cheaper dollars. That's the key phrase. Debt liquidation. You don't need hyperinflation to do it. You need something more controlled. Inflation above rates. For long enough. And the results back then were dramatic. U.S. debt to GDP fell from roughly 106% in 1946 to about 23% by 1974. Not because politicians heroically wrote checks to eliminate debt, but because time, growth, and negative real rates did the dirty work. And researchers who studied 1945 to 1980 found that average real returns on U.S. government were slightly negative around minus 0.3%. That doesn't sound like theft, till you realize it's a 35-year tax on savers disguised as normal policy. Then in 1951, the Treasury-Fed Accord ends the wartime peg because the Fed wanted independence back. Now fast forward to today, and Chris notices the modern version isn't an obvious peg with a press conference. It's something more subtle, an environment where rates can't stay too high for too long, because the interest bill on $38.43 trillion starts eating the country. Chris doesn't need a conspiracy. Chris just needs incentives. And incentives point in one direction. Keep the debt service survivable, even if your savings pays the price. At this point, Chris says, okay, but if the U.S. is quietly liquidating debt, why does anyone keep buying treasuries? Here's the uncomfortable answer. Because the world still runs on dollars. Even with all the talk of de-dollarization, the dollar remains the deepest pool on Earth, and the data shows how large these flows still are. In November 2025, foreigners were net buyers of long-term U.S. securities on the order of $221.8 billion in that single-month split between private and official buyers. So yes, money still flows in, but here's the line you can't cross without consequences. Confidence. A quiet default works only if people keep treating treasuries as the least bad place to park massive money. And here's the pressure point Chris now understands. If investors begin demanding meaningfully higher yields to hold U.S. debt, the debt service cost explodes, which creates the trap. High rates fight inflation, but high rates also blow up interest costs. And this is why quiet default is a high-wire act. Inflation has to be controlled enough to avoid panic, but persistent enough to keep eroding the burden. Add the reserve currency layer. At the end of 2024, the dollar's share of disclosed global FX reserves was around 57.8%. Still dominant, still huge, but not invincible. Chris realizes something important here. This isn't going to flip overnight like a movie plot. It's a slow change until it isn't. Because in markets, gradual becomes sudden at the moment. Confidence breaks. And if confidence breaks, policymakers don't get to choose quiet. Markets choose it for them. Which brings Chris back to the most personal question of the entire video. If the system is built to slowly tax my purchasing power, what do I do without panicking, without gambling, and without pretending this isn't real? Here's the truth Chris has to accept. You can't opt out of using dollars if you live and work in America. But you can stop playing defense with strategies designed for a world that no longer exists. So Chris creates a simple rule. I need money for survival, money for resilience, and money for growth. Layer 1, survival cash, not invested, not optimized. Just enough liquidity so you're not forced to sell assets in a bad month. Layer 2, resilience assets, things that historically don't get quietly diluted the way cash does. Not because they're magic, it's because they're connected to real value. housing, productive businesses, pricing power. Layer 3, growth. Because in a system where debt is managed through debasement, standing still is a slow loss. And Chris makes one more hard adjustment. Chris stops thinking safe means guaranteed. In a fiscal dominance world, safe can mean guaranteed nominal stability and guaranteed real erosion. So Chris starts watching different indicators than headlines, not doom scrolling, just watching the dashboard. Debt growth pace, net interest trend, inflation relative to yields, Fed balance sheet direction. Treasury demand and auction stress signals. Chris isn't trying to time the apocalypse. Chris is trying to stop being surprised. There's one more emotional shift Chris makes. This one matters. Chris stops blaming themselves for feeling like the rules changed. Because the rules did change. When the debt hits $38.43 trillion and interest approaches $1 trillion a year, you don't get the old world back by budgeting harder. You get a new world. And you adapt, calmly, deliberately, before you're forced to. That's how you survive a quiet default, not with panic, with positioning. So here's where Chris lands in January 2026. The U.S. government is not going to pay back $38.43 trillion the way people imagine repayment. Not because someone is evil, because the math makes traditional repayment politically unthinkable. That leaves the path governments have used before: pay it back in nominal dollars. While the real value of those dollars quietly shrinks, default without the headline, tax without the vote, a transfer without the receipt. That's why this video has one message you can't unsee. America's debt isn't disappearing. Your purchasing power is. And if you're watching this as someone who's responsible, who saves, who plans, who tries to build a life without financial chaos, then you deserve clarity, not slogans. So here's what I want you to do. Comment your city and your age. And tell me one thing you've felt get more expensive since 2021 that never really came back down, because your comment section becomes the real inflation report. And in the next video, I'm going to show you how to spot the next stage of the quiet default early, not by guessing, but by reading the exact signals that policymakers and bond markets can't hide. Because if this is the era of quiet default, then the most expensive mistake is staying asleep.